Hi there and welcome to our channel. For those of you that don't know me, my name's Priya and I am a partner at Architecture and Company, the specialist dental accountants. I thought that I would do a video today on tax. Obviously, most of our videos are about tax, but this one is more to do with the timing of your tax. A lot of people ask me, it's usually around January, oh my gosh, why am I paying so much tax in January? Though there's a massive payment, it's more than my tax has ever been before. And then equally other times I'll get sent flowers and chocolates around January because your tax is a lot lower than you thought, or you're getting a refund, which is lovely. And of course, who doesn't love receiving flowers and chocolates? But I can't really take credit for that. It's more the way the tax system works. So every year in January and July, you make a payment on account of your tax for that year. And that payment is based on half of what your tax was the previous year. So HMRC adopt quite a simplistic way of thinking, which you have to do when you're making assumptions, and that is to assume that your tax is going to be exactly the same each year. So if your tax payment was £100 that's very low, say it was £10,000 say your whole tax liability for the previous tax year was £10,000, then the next January and the next July you will make a payment in each of those months of £5,000. So what that means is by the time you come to the next January, you've already made two payments equaling the tax that you had paid the previous tax year. So that means that if your tax was exactly the same that year as it was in the previous year, you'd have no balance to pay in January and you'd have no refund. And then all you would do is you would pay another £5,000 that January and another £5,000 the following July, and you just carry on in the same way. Now, in real life, obviously, our income is not the same every single year. You could have a bad year and you could find that your income actually goes down a lot, in which case those two advance payments that you will have made, which equal half of the previous tax bill, will actually have been too much, in which case in the following Jan, you will get a refund. And then, of course, you'll still have to pay half of that year's tax towards the next year. In practice, if that happens, it's a good idea to keep your accountant up to date with what's going on in your life. And if you think that your income has gone down, then what is far better, I think, than waiting until the following January to receive a refund is that we can just reduce those two advance payments in January and July. And if you've already paid the January one, but you have time to reduce the July one, then we can always do that as well. It's just better from a cash flow point of view. So obviously if your income, that's what happens if your income goes down. If you had a really good year and your income has gone up, that's great. But obviously you have to pay the tax, and it means those two advance payments you will have made will have been too low because your income actually will have gone up, which means your tax has gone up, which means there's a balance to pay in the following January. And the reason it feels like a double whammy is because not only do you have that balance to pay, you also have to pay half of that year's tax, which is higher, remember, towards the next year. So that's why January can feel like a little bit of a killer when your income has gone up. There's a very easy workaround, and that is simply to sit down with me or your accountant and go through how much you should be setting aside every month for tax. And it's a good idea that that amount is not static. That you don't say, well, I'm going to put aside £1,000 every month for tax. Instead, it's a good idea to make it a percentage of what your income is. Because if you do that, then it means that if your income's going up, then the amount you're saving for your tax is going up. If it's going down, then you're putting aside less. It's also a really good idea, I think, not to put aside too much for tax. A lot of people, if I've said to them, set aside 25% for argument's sake for your tax, they'll come back and they'll say, oh, I've been really good, I've set aside 50%. Great, but then the only thing is then you don't know exactly how much of that you need to leave aside for your tax and how much is your pure savings. So it's much better for you to be a little bit disciplined, have your tax account where a certain percentage is going, and anything else can go into your savings account. And the tax account, don't touch it, because sometimes it could be where your income is going up. It could be that you're not going to pay that tax until several months later. So you might look at your tax account and think, there's a lot of money there. Maybe I can take it out and treat myself to a new car. But actually, you might need to leave that there because it's very likely that the following January you'll get a little letter from me saying, well, hopefully not in January. Hopefully I'll give you a bit more notice. But you'll get a letter from your accountant saying, well, actually, you need to pay £1,000,000 in tax, and then you'll wish that you'd kept that money aside. So hopefully that's been useful. If you have any questions on this, please do comment down below. And if there is anything that you would like me to include on my next video, please let me know and I will happily cover it. Thank you so much for watching. Bye.